Warren Buffett has said time and time again that the S&P 500 Index Fund is the best investment most people can invest in. While that advice is simple enough, there are a few mistakes an investor can make while investing in this fund. And if you are not careful, these mistakes could cost you hundreds, if not thousands of dollars in potential profits, or even cause you to lose money altogether. So in this video, I'll be going through 3 mistakes an investor can make while investing in the S&P 500 Index Fund, and how you can avoid them. But before I start, do join my 10,000 members Telegram chat group to discuss or ask any questions that you may have. Alright, the first mistake an investor can make is by investing in the wrong S&P 500 Index Fund. What? Got right one, got wrong one meh? Of course, that's because there are easily 20 over S&P 500 Index funds out there, which by a different fund manager have a different expense ratio, different dividend handling method, and so on. So, which one should you go for? Here, I have a list of some of the most popular S&P 500 Index funds out there. I know this looks complicated, but I promise you, it's super easy to understand. On the left, we have 3 S&P 500 ETFs that are listed on the New York Stock Exchange, namely SPY, IVV, and VOO. If you are an investor from the US, you can just go with either IVV or VOO, since they have a much lower expense ratio of 0.03% as compared to SPY, whose expense ratio is at a whopping 0.09%, and you are done. Simple as that. However, if you are not from the US, things may get a little more interesting. That's because non-resident aliens, aka investors who are not based in the US, are subjected to a 30% dividend withholding tax paid out by US companies. So essentially, for every $1 that you receive from Apple, Microsoft, or even the S&P 500 ETF, Uncle Sam will take away 30% of your holdings, leaving you with the remaining 70 cents. But wait, there's more tax. That's because if you touch wood, pass away while owning these US investments, you'll be slapped with up to another 40% estate tax on your US investments, which leaves your descendants with barely anything left. Now, obviously, this isn't good because we want to keep as much money to ourselves as possible, right? So, the solution is to invest in Ireland domiciled ETFs. Basically, ETFs that are listed on the London Stock Exchange instead of the US Stock Exchange. That's because since the US has a tax treaty with Ireland, Ireland gets to enjoy a much lower 15% dividend withholding tax on US investments. Then at the same time, Ireland has a tax treaty with countries like Singapore and Malaysia. So if you are an investor from there, you will get to enjoy a 0% dividend withholding tax on Ireland investments. When you put it together, by investing in Ireland domiciled ETFs, investors will only be subjected to a lower 15% dividend withholding tax instead of the usual 30%. Here, we have 4 ETFs that are domiciled in Ireland, namely VUSD, CSPX, VOAA, and the newly launched SPYL. And among them, SPYL has the lowest expense ratio of 0.03%. So if you want the cheapest Ireland domiciled S&P 500 ETF, you can just go with SPYL. Now, you may wonder, given that S&P 500 only has a very tiny 1.3% dividend yield, does it even matter whether we go for VOO or SPYL? Yes, it matters. Check this out. Here, I'm calculating the total fees for investing in VOO versus SPYL. When you add up both the dividend withholding tax and the expense ratio, you can see that VOO has a total fee of 0.51%, while SPYL is at 0.27%. Now, assuming you invest $100,000 over 20 years with an 8% annual return, you'll be paying an extra $20,000 in fees if you were investing in VOO instead of SPYL, which is incredibly costly, yeah? By the way, just in case you are wondering how you can buy SPYL, you can head over to IBKR, sign up link down below just in case you don't have an account yet. At the top, search for SPYL and click on the one that says EBS. So you'll be buying it from the EBS Swiss Stock Exchange. But don't worry, it is still denominated in US dollars and is also available in fractional shares. But before we move on, I also want to quickly share how you can invest in S&P 500 using CPFOA and SRS. For CPFOA, the cheapest method would be to use endowers to invest in the Amundi Prime USA Fund. And for SRS, it would be the iShares US Index S&P 500 Fund, also via Endowus. Moving on, the second mistake almost every beginner investor, including me, would make is to try to time the market, where they would try to buy low, sell high, but in reality, end up buying high and selling low, like a donkey. Check this out. The black line here is the S&P 500 index price, and the blue line shows whether money are flowing in or flowing out of the funds. And what you can see that whenever the S&P 500 is doing really well, like in 2000 and 2022, a lot of money tend to flow in, and people end up buying near the peak. Then whenever the S&P 500 crashes hard, money tend to flow out, where people end up panic selling near the bottom. Warren Buffett has famously once said that the stock market is the only place when the items go on sale and people run out of the store. But check this out, the S&P 500 has went through many difficult times, such as World War II, Cuban Missile Crisis, oil crisis, Black Monday, dot-com bubble, the pandemic, and yet it has still came out on top. And if we dissect the S&P 500 returns, a huge part of it comes from the earnings per share growth of the companies, which have been growing relentlessly throughout the years. So how is it that the S&P 500 index could perform so well? The reason for this is simple. When you are investing in the S&P 500, you are not just investing in that specific 500 companies in the index, but rather you are investing in whatever 500 companies that meet the criteria to join the S&P 500 index. For example, in order to join the index, the company needs to be from the US, market cap must be at least $8.2 billion, its shares must be highly liquid, but more importantly, it must report positive earnings in the most recent quarter, and the total earnings for the previous 4 quarters must be positive. Then, even when the companies fulfill all these criteria, they will still need to be approved by the committee before they can join the index. And here's the best part, the S&P 500 has a self-cleansing mechanism, because whenever a company performs too badly, it will be kicked out of the index and be replaced by another better performing company. When you combine all these factors, you end up with the S&P 500, which ensures that you are investing in the profitable, good quality companies at all times. Take for example, back in 1992, the top holdings were mostly dominated by non-tech related companies, and Microsoft was only in the 16th place. Then fast forward to today, the top holdings have been replaced by better, stronger, and faster growing companies. So how can we avoid timing the market altogether? Simple, we just consistently dollar cost average into the stock market. Market up, you buy. Market down, you buy while crying a little. One easy way of doing this is to set up recurring buys on your broker, where it will automatically buy into the S&P 500 ETF periodically. So for example, in the IBKR web portal, you can just click on recurring, enter the investment amounts, how often you want it to invest for you, then click on no end date, so that it will keep buying for you until you manually stop it. And here's a pro tip. While IBKR usually charges a $2 commission whenever you convert your currency, by using recurring buy, IBKR will automatically convert your currency, and you will get to avoid the $2 currency conversion fee. So that's nice. But here's a question. Is it a mistake to go all in into the S&P 500? Because while the S&P 500 is the strongest and most popular index in the world, it only takes up about 60% of the global market. There's still other countries like Japan, UK, China, France, Canada, and so on. So if you were to just invest in the S&P 500 index alone, we could be missing out on the returns from the rest of the countries. For example, in the past, the US market and the international market have taken turns to outperform each other. Like back in the 1970s, the international market was doing better. Then in the early 1980s, it was the US turn. Then it later switched back to the international market, and so on. This continued all the way to the early 2010s. That's when the US market started outperforming the international market all the way to now. Or another example, just a little over 100 years ago, the US market was just a tiny 15%, whereas the UK market was the largest market at that time. So could there be a day when other markets starts to outperform the US, and by going all in into the S&P 500, we could be missing out on all the gains? Now obviously, no one knows what might happen in the future, but here's my theory. In the past, the top companies in the S&P 500 derive most of their revenues from the US. But fast forward to today, where we are now in a more interconnected world due to the internet and globalization. Many of the S&P 500 companies derive a huge part of their revenues globally. For example, back in 1948, foreign profits accounted for less than 5% of the total corporate profits. But by 2018, this has increased to almost 30%. And unsurprisingly, for many of the large tech companies, its percentage is even higher. For example, Apple earns 64% of their revenue overseas, Microsoft 50%, Google 53%, Nvidia 56%. Besides that, the other reason the S&P 500 is so strong now is because many foreign companies are now choosing to list on the US stock exchange. For example, a growing number of European companies are moving to the US exchanges. Same for the Chinese companies, and even Singapore companies prefer to list there too. That's because the US stock market gives them more access to more investors, there's better liquidity, higher visibility, and so on. And it's not as though any company can just list there just like that. Instead, they must first meet all the strict requirements in order to be accepted. And over time, we end up with the biggest, most popular, and best stock market that we have now. However, with that being said, since we can't predict the future, I guess it never hurts to add some diversification into the portfolio, such as the All World ETF, VWRA, to reduce some of the geopolitical concentration risks. So that was the 3 mistakes an investor can make when investing in the S&P 500 index fund. What other mistakes do you know of? Do comment down below and let me know. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.